Welcome back. Well, the S6 Nifty is up 200 points, so it looks like a big gap up, and then we'll take it from there. Remember, we are sitting on a massive rally already, but then that's markets for you. Rajesh Bhatia is joining us, MD and CIO at the Investment Trust of India Long Short Equity Fund. Rajesh, hi, good morning. Thanks a lot for joining us. Let's start with IT first, because in your long short fund, you have the biggest exposure in terms of strategic longs on Infosys at 5.7%. And even in terms of tactical longs, you have HCL Tech at almost 4%. Do you get a sense that the correction is out of the way here, and these stocks, large cap IT, Infosys, HCL Tech, can move up from here?
Sure. So Anuj, I think there was an earlier narrative that US will have to go into a deep recession to tame inflation. And even though some of the other factors were turning favorable for the IT services business, which was attrition coming down, and therefore the pressure on manpower costs was receding. I think the IT companies continued to see pressure on the stock prices because of this fear of a recession. I think that narrative is changing at the margin. And I think in the US, what you're seeing is consumer spending coming down, housing prices correcting, hiring slowing, etc. And all of that is leading to the belief that the slowdown has probably already started, and therefore the terminal rates for the Fed will not be as stiff as earlier envisaged. Given that context, I think IT services are really poised well because the valuations have corrected, and the key challenge that they were facing in terms of manpower costs, I think, are now slated to cool off at least. At least directionally, they're expected to cool off. Last night, I think Capgemini reported, and I think they kind of alluded to the same trend, which is, attrition is going to come off as you move forward. That's a significant positive for the IT services company. And given that the demand environment will continue to remain relatively robust and not go into a deep slowdown, is also a very, very strong positive. So I think from a shorter term perspective, at least, I think IT stocks look very attractive.
I kind of completely agree with you, Rajesh. Good morning, Prashant here. But just to put a counter to that, I mean, right? It's you said you yourself said it's just the recession has probably already started, slowdown already started, but we're just starting that now, right? It'll play out over the next 6 months, maybe more. And IT services, of course, depend entirely, a very large part to US companies, etc. Where does that leave us? Valuations, etc., have come off, but will these stocks do very well from here? Are they it's all relative. Are they? Would you want to own them over anything else in the market right now? Yeah.
So, I think, Prashant, as we all know, this is all a macro-driven, narrative-driven market. And we are usually surprised by how much linkages India has to the global market, not only as far as markets are concerned, but also even sectoral moves are concerned. And we probably underestimate that at a certain level. Now, I told you that basically the narrative has changed to a slowdown already being started, and therefore the terminal rates for the US Fed will not be as steep as earlier envisaged. Having said that, there is an alternate narrative that has been more prevalent. This new narrative that we are talking about is more of recent vintage. The earlier narrative was with CPI at 9.1% and inflation. I was looking at what global fixed income asset managers forecast as inflation in America. They still say that it's going to be 7.5% to 8% even until the year end. And therefore, there is no scope for the Fed to slow down interest rate increases, and that they would need to slow the economy down significantly and keep interest rates high for a prolonged period to make sure that the inflation expectations are killed. And that is a alternate narrative which was doing the rounds earlier of a deep recession. Having said that, like I said, I think at this moment, the narrative has changed to no, the terminal rates are not going to be that high. Now, if you look at the price action, it is betting on the narrative that terminal rates need not be high. Whether you're looking at the bond market, last time I checked, the 10-year had dropped to less than 2.7% from 3.2, 3.3%. Even equity markets are kind of showing you the same resilience, and so are commodity markets, minus energy commodities, are kind of heading in that direction. So that's why I said in the shorter term, we will have to remain dynamic as you move forward. But in the shorter term, this narrative is there in the mind of the market, and that's what is prevalent.
Okay, all right, Rajesh, request you to hold on. We're just going to invite a management. We're coming back to hear more from you.